All right, well, welcome to Chapter 10. Chapter 10 will discuss externalities. This is the first time that we will look at the microeconomic side of economics. Our first 9 chapters, for the most part, focus on macroeconomics, aggregate overall economics, and how fluctuations affect markets. We'll start to begin for the next remaining chapters and for the remaining of this semester, focusing really on the microeconomics of this economics course. So anyway, so to move on to Chapter 10. Chapter 10 will have different sources of externalities and the variety of potential curves and for externalities that are addressed. We'll look at how markets are maximized, total surplus to buyers and sellers. We'll also look to see how in a market, if a market generates externalities, a cost benefit to someone external in the market, and in the market equilibrium may not maximize to the total benefit of society. So the equilibrium may not always be what's equal to what society's demand or the social costs, and we'll talk about that too. So first, let's talk about externalities. The book's definition for externalities are the uncompensated impact of one person's actions on the well-being of a bystander. So if say person A and B are doing something and it's person C has an action or impact on the well-being of person C. If the impact on the bystander is adverse, we say there's a negative externality. If the impact on the bystander is beneficial, we say there's a positive externality. In either situation, the decision makers fail to take account of the external effects that the behavior will have. Externalities are the effect on the market that are done by the third party. Okay, so first let's talk a little bit about welfare economics again. We talked about it in chapters 8 and 9. I'm going to talk a little bit about it, a lot about it in 10, because it goes forward with the externalities. So we look at the demand curve for a good that reflects the value of the goods to the consumer. It's measured by the price the marginal buyer is willing to pay. The supply curve for a good reflects the cost of producing the good. In a free market, the price of the good brings supply and demand into balance and in a way that maximizes the total surplus. Remember, we've talked about surplus for the last 4 chapters. The difference between consumer valuation and the good and sellers of cost of producing it will be what is your surplus and where your margins are made and where your profit revenues are made. So let's talk about negative externalities first. Negative externality is a cost that is suffered by a third party as a result of an economic transaction. In a transaction, the producer and the consumer are the first and second parties, and the third party may include individuals, it could be an organization, it could be a community, a property owner, or any resource that is indirectly affected. Our example that they give in your PowerPoint and the one they use for the graphs is an aluminum firm that emits pollution during production. Social cost is equal to the private cost to the firm of producing the aluminum plus the external cost to those bystanders affected by the pollution. Thus, social cost exceeds the private cost by the producers. The optimal amount of aluminum in the market will occur when the total surplus is maximized, as we've discussed in previous chapters. Total surplus is equal to the value of aluminum to consumers minus the cost, including the social cost, of producing it. This will occur where the social cost curve intersects with the demand curve. At this point, producing one more unit would lower the total of surplus because the value to the consumer is less than the cost it is to produce it. Because the supply curve does not reflect the true cost of producing the aluminum, the market will produce more aluminum than is optimal. The negative externality could be internalized by a tax or producers for each unit of aluminum sold to make a difference, to be able to use that to help with the social cost. What is internalizing an externality? It's the altering incentives so that people take account of the external effects of their actions. This leads to positive externalities. So what is a positive externality? It's the benefit that is employed by a third party as a result of an economic transaction. Third parties, again, can include individuals, organizations, communities, property owners, or anyone that has a resource that is directly affected. So let's talk about a positive externality. The great example, and I believe the one in your PowerPoint, is education. Education yields positive externalities because better educated voters lead to a better government. Better educated individuals are less likely to commit a crime, so therefore crime rates are also more likely to drop as the education level of the population rises. In this case, the demand curve does not reflect the social value of the good. If there is a positive externality, the social value of the good is greater than the private value, and the optimal quantity will be greater than the quantity produced in the market. To internalize a positive externality, the government could use a subsidy. For example, let's talk about a couple I believe is also in your PowerPoint. Technology spillovers, industrial policy, and also patent protection. A technology spillover occurs when a firm's research and production efforts impact another firm's access to technology advancements. It's difficult to measure the amounts of technology spillover that can occur and leads to debate over whether or not the government should pursue policies to engage the protection of technology. Should the government be involved in helping a corporation become better, more efficient? Also, if we look at patent protection is a type of technology policy of the government because it protects the rights of inventors who create technologies. Without patents, there would be less incentives to develop new ideas and new technologies. Without patents, people would also take something somebody would invent and make money off of it because they may have better ways of distributing it or better means of getting it out, and therefore leaving the inventor lost. When an externality causes a market to reach an efficient allocation of resources, the government can respond in two ways. The first way is command and control policies, and also would they regulate behavior directly, and also market-based policies to provide incentives so the private decision makers will choose to solve the problem on their own. Externalities can be corrected by requiring or forbidding certain behaviors. In the United States, the EPA developed the Environmental Protection Agency, develops and enforces regulations aimed at protecting the environment. The EPA includes maximum levels of pollution allowed, required adaptations of particular technology to reduce emissions, several things of protection on the job, also the air, the environment, and other things that the EPA also follows through with. So we look at market-based policy and the externalities that can be internalized through the use of taxes and subsidies. So let's talk about corrective taxes. The book defines corrective taxes as a tax designed to induce private decision makers to take account of the social costs that arise from negative externalities. It's when the government gets involved with a company saying, you're producing this, but it's also harming the community or it's harming the welfare of our society. These taxes are preferred by economists over regulations because the firms that can reduce the pollution with the least cost are likely to do so. This will avoid the tax, while firms that encounter high costs or reducing pollution will simply just pay the tax. Thus, the tax allows the firm to face high costs of reducing pollution to continue to pollute while encouraging less pollutions overall. So the overall aspect of it is to get the firm or the manufacturing business to produce less pollution into the air, not so much just that they make so much money they can pay the fine. So what we want is for them to work using technology to not pollute the air instead of just paying the fine.